This conference will now be recorded.
Good evening, everyone present for the session today. I hope all of you have joined the session. In case you haven't, please make sure you join faster. Okay? Right. So, in the previous class, we had discussed about the cost of goods sold. Okay, how it is generated. How do we compute the COGS? And we also solved a few case studies arriving at the revenue, right? So now we're just going to further up and then go to the next one concept, which is gross profit. Okay, so please open your Excel file. Let me share the screen with you. Right, so we had done the cost of goods sold, right? So I hope till here you all don't have any doubts. Okay, so now we are going to start up with the GP, which is your gross profit. Okay, so what is basically gross profit? Gross profit is nothing but sales minus cost of goods sold. So sales minus cost of goods sold, we arrive at the gross profit. So here, first case we have where a mechanic shop reports 15,000, okay, in revenue for April. They spend 10,000 on the cost of goods sold. Find the gross profit. Okay, so a mechanic shop reports 15,000 in revenue for April. So total revenue generated for the month of April is 15,000, and overall how much they have spent to generate this revenue, it is 10,000. So how do you find the GP? GP is nothing but a revenue minus the cost of goods sold. So it is very easy. So orally also you can put up the answer equals to 15,000, that is this, right? Minus revenue minus your COGs. So again, the cell referencing once again. It's going part. So what you can do is you can just put it up 15,000, which is your COGS, minus 10,000. So 5,000 is your GP, your gross profit. The next case, what's the next case say? Bought 100 books worth 100 per book, sold 100 books for rupees 200 per book. So find the COGS and the gross profit. So to carefully understand, total books bought are 100 books. Okay, and 100 books are bought and all the 100 books were sold. So now what is the total revenue generated on the sale of 100 books? It is 100 books into 200 per book. So equals to 100 into 200. So this is your revenue generated. Okay, 20,000. So what is the COGS now? Cost of the goods sold. How many books were sold in total? 100 books were sold. So what was the cost per book of the goods sold? So which will be 100 into 100. So it will be equals to 100 It is 10,000. So how do you arrive at the GP? Equals to revenue minus cost of goods sold, and you press enter, you get 10,000 as the gross profit. So I hope all of you have got the two answers. Okay, fine. So third one, why can't you make an attempt in solving it? Then I will solve it for you. Third one, case 3, can you make a try and give me the answer? It is similar to case 2. So what answer you have got for the third case? No replies yet. You can put up in the chat box what answer you've got for the case 3. So once you have had the answer, put up in the chat box. So here you have two cases. See, one, in that case 3, bought 100 books worth 100 per book. Out of 100 books bought, 50 books were sold, priced at 200 per book. So what is the revenue one? 50 books are sold, okay, and at a price of 200 per book. So 50 into 200. Revenue 2 is what? Buy 120 books will be 100 per book. Out of 120 books bought, how many books were sold? 80 books were sold. So it will be 80, and 80 books were sold at a price of 200 per. So 80 books at a price of 200 per book. So this is revenue 2. So what is your revenue 1? Equals to 100 books. Out of 100 books, how many were sold? 50 books. So 50 into 200. 10,000. Your revenue 2 should be what? Out of 120 books bought, 80 books were sold. Equals to 80 into, it is 200. Okay. So what is the COGS one? Cost of the goods sold. In the case one, what is the cost? Out of 100 books, 50 books were sold. Correct. So what is the cost of these 50 books? The cost of these 50 books is rupees 100 per book. So equals to 50 into 100. And what is COGS 2? Equals to 80 books were sold. And what is the cost price of these 80 books? 100 per. how do we arrive at the gross profit? You have to sum up actually both. See, in the first case, revenue one is 10,000. So 10,000 minus 5,000. So 10,000 minus 5,000 is 5,000 in the first case. Second case is what? 16,000 minus 8,000 is 8,000. So 8 plus 5, which comes up to 13,000. This should be your answer.
Ma'am, for COGS 1, I did 100 into 100, and
Yeah.
for COGS 2, I did 120 into 100.
No, ma, you cannot do like that. I've explained you, right? See, what is the cost of the goods sold? The terminology itself defines you, right? Cost of the goods sold. How many were sold? In the first case, out of 100 books bought, how many were sold? 50 books were sold. So, what is the cost price of these 50 books? It is 100 per book.
Okay, ma'am.
Like that, you have to understand it. In the second case,
Okay.
also, total books 120 books were bought, and out of 120 books bought, 80 books were sold. So what? So the selling price of 80 books is 200, correct? But what is the cost price of these books? 80 books sold. It is 100 per book. So it will be 80 into
Okay.
100. Okay.
Okay. Thank you.
Okay. Okay. 4,000 is for which, ma? I'm not able to understand. 4,000 is for which you bought. All of you have replied it's 4,000. Yes.
Ma'am, for gross profit.
Huh? Gross profit.
Yes, ma'am.
So how did you arrive at this 4,000 as a gross profit? By
Ma'am, I
doing
took the
that.
COGS wrong, ma'am. Yeah, I had
Oh,
taken 100 into 100 and 80 into
okay.
200.
Okay,
Sorry,
okay.
120 into 100.
Okay. So now you make the corrections, then you get the right answer. Okay.
Yes.
Yes, all of you have arrived at this answer. All of you have made the corrections. Fine. Right. So in case if you're finished working still, anyone is working on the same? Otherwise, can we move on to the next case? So I will proceed to the next one, which is your profit and loss statement. So here, I've given the question as prepare a multi-step income statement. Okay? Prepare a multi-step income statement for Apple Company, which is a clothing retailer, for the year ending 31st December 2003, given the information below. Okay, so we have to prepare a multi-step income statement for this company for the year ending 31st of December. So how do you generate the income statement? So let's start with this. So please open this file and we'll begin with the generation of the income statement. Okay. So here we have got the list of expenses and the other entries as well. Okay. So here we have got advertisement expenses, opening stock, depreciation of 78,000, closing stock or ending inventory, gross sales 32 lakh 10,000, interest expenses 64,000, lease payments 52,000, management salaries 2 lakh 40,000, purchases 24 lakh 25,000, R&D research and development expenses 35,000, repairs and maintenance cost 22,000, returns and allowances 48,000, and taxes is 51,000. Okay, these are the list of expenses. With this, you have to arrive at the EAT. EAT stands for earning after tax, your net income. Okay, so in the initial stage, I should write with this net income we're going to generate it for this income statement. So let's begin together. So first you have to arrive at the first you have to arrive at the COGS. Okay, because sales minus cost of goods sold will give you the gross profit. Okay, so what is the sales here? Your gross sales is 32 lakh 10,000. Okay, so I'll put up the sales here. Okay, sales minus cost of the goods sold. So your cost of goods sold, how do you arrive at? Opening stock plus purchases minus closing stock. So it will be like minus COGS, or I put the COGS in the brackets. So here I'll show you the calculation. What is COGS? Equals to opening stock plus purchases minus closing. Okay. So accordingly, how will I? So what is the opening stock here? Beginning inventory is 2,56,000. So your COGS equals to 2,56,000 opening stock plus. So what is the purchases made? Material purchases we have around 24 lakh 25,000. So this 24 lakh 25,000 minus 24 lakh 25,000 minus, yes, what is your closing stock? Your closing inventory is, it is 2 lakh 48,000. So this should be your COGS. Okay. So opening stock is how much? 2 lakh 56,000 plus purchases made 24 lakh 25,000 minus closing stock of 2 lakh 48,000. Okay. So what is the amount here I at? Here only I will show you. You can also do in Excel itself. In short, I'm showing you, that's it. So you can see both the ways. Okay. So it is 2 lakh 56,000 minus 2 lakh 48. So if you have got this, 24 lakh 33,000 24 lakh 33,000. So your GP, your gross profit, equals to sales minus cost of goods, which will be 7 lakh 77,000. Have all of you got the GP 7 lakh 77,000? Good. So next we go to the next step. So we arrive at the GP at 7 lakh 77. So now we have to arrive at the next step, which is your EBITDA, earnings before interest, tax, and depreciation. Okay, so what is the formula for the same? I'll come here itself. Okay, EBITDA stands for earnings before interest, tax, and depreciation. And how do we arrive at this? Is it is your gross profit minus operating expenses. Okay. So how do you arrive at the EBITDA? EBITDA basically stands for earnings before interest, tax, and depreciation, the full form of the same. And how do you arrive at it is? It is your gross profit minus all the operating expenses. So gross profit already we have got. What are all the operating expenses? Let's start. What do you mean by operating expenses basically? Are you aware of the term? We have two kinds of expenses. One is non-operating expenses. Second, we have is this operating expenses for a company. So, how do you understand um, as operating expenses? Your understanding? Yes. Can I have response from your side? How do you understand operating expenses? Because it will be easier for you to go to the next step. If you know, fine. If you don't know, it's fine. But don't take any other measures, any other steps to find out what is operating expenses. To be frank, if you know, it's fine. You can answer in your own words. So don't any kind of supportive measure for the same. In case if you don't know, it's fine. I will make you understand. One of you know? Fine. So we have two kind of expenses. One is operating expenses, the other is non-operating expenses. What do you mean by operating expenses? Operating expenses are those expenses which are routine for a company every month, or once in 15 days, or however it could be. It is routine expenses for the company, which is it is quite often we have these expenses incurred by the company. These are operating expenses. So examples for the operating expenses, classic examples, you have rent. Every month rent has to be paid. Yes. Salaries, every month salaries has to be paid. Next, you have like discounts. So on sales we are allowing discounts. So all these are routine expenses which are incurred by the company and which are called as operating expenses. Okay, stationery purchased, advertising. So all these are routine expenses. But what about the non-operating expenses? Non-operating expenses are those expenses which are not routine expenses. And the classic example for non-operating expenses is depreciation. Because depreciation is completely a non-operating expenditure. Now, every month we will not have depreciation. Every week we will not calculate depreciation. At the time when the assets, are out or they are on sales, okay, and in cases where depreciation has to be calculated, it is considered. Otherwise, we don't even consider or we don't even think about depreciation. So, though depreciation is an expenditure, with the to be frank, on a full-fledged basis, if you have to define depreciation, depreciation is a non-operating expenditure. It is not a routine expenditure which is incurred by the company. It is completely non-operating expenditure. Okay. So here, now we have to subtract all the operating expenses from the gross profit to arrive at the earnings before interest, tax, and depreciation. Okay, so let's continue. So let's start with the operating expenses here. Okay, so which is the first one? Here we have is this advertising expenditure. So we have around 68,000. Next. Okay, interest you're not supposed to take because interest, as I've told you, interest here we are subtracting from the EBITDA on interest and depreciation. Okay, so we can consider lease payments, which is 52,000. Management salaries 2,40,000. R&D 35,000. Repairs and maintenance 22,000. Next. Returns and allowances 48,000. Returns and allowances 48,000. Okay. So after this, you're going to arrive at the sum of all these expenses. Okay. So total operating expenses. So how do you calculate total operating expenses? Equals to sum. Close the brackets. Select from advertisement till returns and allowances. You get 4,65,000 as the total operating expenses. Now, how do you arrive at the gross profit minus operating expenses? You arrive at EBIT DA. EBIT DA. Earnings before interest, tax, and depreciation. So, equals to 7,77,000 minus 4,65,000, which is 3,12,000. And out of this, the first thing which you're going to put off is your interest. See, you come accordingly. Interest, I stands for interest, T stands for tax, D stands for, DA stands for depreciation. So minus interest. Okay. So interest. Okay. So what is the amount of interest involved here? It is 64,000. Okay, so here you arrive at the EBITDA. You are going to take out the I from now because we are going to remove now. EBITDA. So equals to 3,12,000 minus 64,000. So it is 2,48,000. Then tax, depreciation. So depreciation comes up to 78,000. One second. My voice is audible, right? Yeah. So here, now to arrive at the earnings after tax, your net income available. Yes. So here you're going to deduct the interest, or first you can, to arrive directly at the earnings after tax, what you can do is first you can go on for the subtraction of your depreciation. So either ways it's possible. So this is the most convenient way for you. So see, if we repeat it again, okay, one give me a second. Yes. So yes, you are here, right? You have arrived at EBITDA. EBITDA stands for earnings before interest, tax, and depreciation. So minus, you can first put up your depreciation. If you put up interest payments also, no harm. Okay, still the solution remains correct. So first you can put up your depreciation minus depreciation. So what is depreciation amount here? It is 78,000. So it will be 78,000 here. So after depreciation it becomes EBIT, earnings before interest and tax. That's all. No DA. DAs we have deleted it because you have subtracted depreciation, equals to EBIT DA minus depreciation. So 2,34,000 is EBIT minus, it will be interest. So what is interest payment? It is 64,000. So after interest it becomes what? Earnings before tax. So it will be equals to 2,34,000 minus interest. So again you remove I. So it becomes EBT. Now you have to remove T, tax. So what is the tax amount? It is 51,000. So 51 EAT equals to minus. So you should be able to get 1,19,000 as your earnings after tax. So complete this calculation now. In case if you're unable to understand any step, let me know. So take your, complete of this table, arrive at the EAT. Yes, are you done? Still anyone is walking out, you can finish off the table. Anybody is still completing the table? So shall we go on to the next one? It is P&L2. So you have a next case study here. Okay, so if this is clear for you, now we have P&L2 there. Let me just click on the next sheet. It is similar to the case 1, P&L1. So here it has been even more easier for you. And yeah, I'll just explain you once. See, the current case, here we have what assumptions are being put up. 1 lakh are the total number of units which are being sold. Okay, and these units are sold at a price of 125 per unit. Okay, so total number of units sold is 1 lakh and the selling price per unit is 125 per unit. So what is the cost per unit? Cost price per unit, it was 75. Selling price is 125 per unit. Cost price per unit is 75. And each year, revenue increases by 15% and the COGS also increases by 20%. So this already, I think you have had the experience of working on the same, where each year revenue increases by 15, each year COGS increases by 20%. So what do you want to do? Now for the first year, what is the sales? The sales for the first year is how many units have been sold? 1 lakh units have been sold. Right? So equals to 1 lakh into selling price is 125 per unit. So your total sales is 1 crore 25 lakh. Next. Now, what is the COGS for the first year? 1 lakh units have been sold and the cost price of these 1 lakh units is 75 per unit. So equals to 1 lakh units into 75 per unit. So which comes up to 75 lakh. So what is the GP for the first year? Equals to sales minus cost of goods sold. You get around 50 lakh as the gross profit. Okay. Now it says selling and administration cost is 25% of what? You can just click on this, it will give you one note. Selling and administration costs are 25% of revenues of that year for that year. So 25% of the revenue will be your selling and administration costs. So equals to revenue into 25%. So beyond 31 lakh 25,000. So how do you arrive at the EBITDA now? I don't know gross profit minus operating expenses. So it will be equals to your gross profit minus operating expenses. Okay, 18 lakh 75,000. Already depreciation is being put up here, so no worries. So how do you arrive at the EBIT? Your EBITDA minus depreciation equals to minus depreciation. Okay, then interest has been put off in the table. So your taxes equals to EBIT minus interest. Okay. So taxes again 30% of the EBT for that period. 30% of your EBT. So equals to EBT is this into 30%. This is the amount you want to get. So finally you arrive at equals to EBT minus tax, which is your EAT. This is your EAT you should be able to get for the first year. Now for the second year, what has been given here? For each year, revenue increases by 15%. So what you're going to do here equals to revenue into 1 plus what is the increase? It is 15%. So this is much. Same thing with the COGS. %20. And then you arrive at the gross profit equals to sales minus GP. This can also be done by dragging it up. Accordingly, calculate the selling and administration equals to, it says 25% of revenue of that year. So revenue into 25%. This is okay. So continue and complete the calculation. Yes, please complete the table. Are you done? Have you completed the generation of the EAT, all of you? Because time is given for you to complete the table. I can just go off like that, but it will be not proper. Because if sufficient time is given to you, you'll be able to do it simultaneously along with me. That is the main intention of mine. So, in case if you have done, then we'll move on to the next step in your financial model. Fine. So, I hope all of you have got the same answer. This is how we arrive at your net income or the earnings after tax or the profit after tax. So, these practical exercises are very informative, very knowledgeable for you. Now, I'm going to share a new file, the WhatsApp group, which I have downloaded. So, till now, we have worked on with different concepts in financial modeling, starting with the topics on Excel, then slowly getting up for time value of money, then generation of income statements, and now we're going to start with the case studies in your financial modeling. So I'll show you the file of the first case study, which will be starting off now today. Okay, so let me share the file in your WhatsApp group. So I'll be sharing with you two files. One is a Word file, the other is an Excel file. So first you have to go through the Word file, not the Excel file. I hope you have received the file. So first you're going to open the Word file and just go through the case study. take around 5 minutes to go through the case study. Time will be given to you because if you don't go through the case study, if you don't understand the case study, then to work on the case, it will be difficult for you. So that's why take at least 4 to 5 minutes time and just go through the case study. Once you are ready, then I will start from my side. Because without going through that, if I practically show you, no, your understanding level will not be 100%. So make sure first you go through, understand. If you're not able to understand, go through it again. But at least read through once, twice, depending upon your flexibility. So start now. Go to the Word file. So this is the case study which I was talking about. Yes, have you done? Go to the case study. Are you able to understand what is the case study about? Yes, you're still going through the same. Right? Have you gone to the case study? Let me explain the case study now. See, here it says ABC Company is a franchisee of Apollo Pharmacy, sells 150 strips per day of a low budget drug A drug, at an average contribution of 25 per strip, and drug B, which is a high budget drug, it sells 100 strips per day at an average contribution of 60 per trip. Now, sales and volume and the average price are expected to grow by 5% every year for both drugs. So, I'll repeat this para again. ABC Company is a franchisee of Apollo Pharmacy. Okay, and this ABC company is actually into the medical business. So sells 150 strips per day, which is priced at, of course, at a very low price, 25 per strip, and 100 strips per day of 500 drugs, which is an average of 60 per trip. So sales volume, an average price are expected to grow by how much? It is 5% every year for both the drugs. So, now to operate this franchisee, it needs to have how much space? 250 square feet space for the rental shop with a lease rental of 100 per square feet per month. Now, to start up this business, what is the square place? How much place is required? Square feet and everything. 750 square feet is required to start up this retail shop, and the lease rental for the same is for every square feet or per square feet it is 100 per month. And it is a rental contract for a period of 5 years, and deposit of 10 lakhs have to be made at the start. Okay. So again, third part. A one-time renovation of the premises worth 20 lakh will need to be incurred at the start. So some renovation is required for the premises to be done to start up this business. And what is the total cost of renovation? It is 20 lakhs. And of course, once it is being started, of course, I require some people, some staff. So required personnel costs are 80,000 per month. Okay, so 80,000 is paid per month salary for the personnel. And the salary will also increase in the economy by 7%. So wage inflation in the economy is 7%. Other operational costs are expected to be 25% of the contribution, which is 25% of sales, generated for the period. Tax rate in the economy is 35%. So tax losses cannot be carried forward, so the tax cannot be carried forward. Okay, and and the initial investment, which is nothing but deposit plus innovation can be funded by 60% bank loan. Uh, so, so this is available at 12% interest rate. Okay, and the remaining should be funded by using your equity. Now the debt is to be repaid. Now how much loan is being taken for all these things? The debt is to be repaid at the end of the fifth year in lump sum. Okay, and other investment opportunities. Okay, with ABC company is expected to provide around 20%. Okay, right. And the last one, evaluate the business opportunity for the projected life for how many years? It is 5 years. And after 5 years, the franchisee too will be funded over the approved policy. So here, after 5 years, the franchisee will be handed over to Apollo, and the deposit will be refunded to ABC company. If ABC company wants to invest shares in the public, okay, so what is the expect? Right. So hope all of you are clear with this case study here. Just initial part we want to do here. Just open the next this one Excel file. Have you opened the Excel file? Pharmacy workbook file. Yes. No response from your side. Good. So let's start with the case now. We take few steps and then we will continue later. See, pa here we have 5 years because it's a 5 year period what we're doing working out now. Now, as I've told you, we have two types of drugs. We have drug A and we have drug B. Okay. Now, drug A. So, what is a commission in the sense is the selling price per unit. Okay, commission is also regarded as a selling price per unit. So, per day, please look here, this is very important. Per day is what you're calculating first, then annually will go. So, in the year one, what is the selling price per unit of drug A? Selling prices, how many strips are being sold? I want the price at 25 per strip. So here you have to put up as 25. What about drug B? Drug B is being sold at an average price of 60 per strip. Okay, and this price is expected to increase or grow by 5% every year for both the drugs. Okay, so 5% every year. So how do you do this? Equals to 25 into, in the brackets, 1 plus 5%, 26. Right, and further the same thing for drug B. 1 second. Oh, sorry. Percentage. Yeah. So it should be around 63. So this you won't take up to all the years now. Okay. Same thing with the units sold. How many units have been sold per day of drug A? Here also to calculate the increase of value. So both will be applicable. Not only for the units but also for the price. So drug A, how many strips have been sold? 150 strips per day. And drug B, 100 strips per day. Equals to 150 into 1 plus 5%, 158 equals to 100 into 1 plus 5% 105. So this you're going to drag off now for the rest of the columns. Okay, so you can stop here. So the remaining calculations will be did in the next class for you. So this you can save and you can we'll continue from this in the next class. Okay, so see you on Monday then, your next session.